Well, we're back at it again, talking about taxes. And yes, I know, probably not the most thrilling topic in the world. Your investments are probably down a little bit. Tariffs are looking like higher costs are going to be our new normal. But there's the thing. If you care about passing wealth to your family, you need to pay attention. Because if you are not careful, the IRS is going to get a much bigger chunk of your estate than you ever intended. There's been some talk lately about the federal estate tax exemption dropping in 2026, and with it, a rush of people considering gifting assets to their heirs before the exemption shrinks. And on paper, it makes sense. Move assets out of your taxable estate now while the exemption is at its highest point, right? But before you start transferring real estate or stocks to your kids, let's take a deep breath. Because there's a huge mistake people are making with this sort of strategy, and it's one that could end up costing their heirs a fortune in capital gains taxes. So what's that mistake? Forgetting about the stepped up tax basis. So if you want to make sure that your family isn't hit with unnecessary taxes when you're gone, let's go through everything that you need to know. What's changing, why gifting now isn't always a good idea, and what you should be doing instead. Hit the like button, subscribe, share this video with your kids to help explain why they can wait until after you die to get your stuff, and let's get into it. Right now, we are in what can only be described as a golden age of estate planning. The federal estate tax exemption is sitting at $13.99 million per person, or $27.98 million for a married couple. That means unless you have assets worth more than that, you don't have to worry about the federal estate tax. But here's the problem. That exemption is set to be cut in half in 2026 unless Congress steps in. That means it could drop to somewhere around $6 million per person, adjusted for inflation. And suddenly, a lot more estates could find themselves in taxable territory. Understandably, this has a few people panicking and saying, all right, let's start gifting assets now while we still have room under the current exemption. But while gifting can be a great strategy in some cases, it's not a one-size-fits-all solution. In fact, if you're gifting appreciating assets, you could be passing along a massive tax burden instead of protecting wealth. Now, let's talk about capital gains taxes for a second, because this is where things get interesting. When you own an asset, whether it's real estate, stocks, or any other investment, and you sell it for more than what you paid for it, you owe capital gains tax on that difference. Pretty straightforward. Now, here's where gifting can actually backfire. If you gift an asset to your child while you are still alive, they receive it at your original purchase price, your tax basis. So if you bought a house for $200,000 and today it's worth $1 million and you gift it to your child, well, guess what? They now have a $200,000 tax basis. If they turn around and sell it, they owe capital gains tax on $800,000. The appreciation from $200,000 to $1 million. But if you wait and let them inherit it, the IRS gives them something called a step up in basis. That means their new tax basis is the fair market value at the time of your death. So in this case, $1 million. Now, if they sell it for $1 million, they owe nothing in capital gains tax. That's hundreds of thousands of dollars saved by just waiting. Let's say grandma has a stock portfolio. Years ago, she bought shares in a company for $50,000. Over time, that stock has grown, and today it's worth $500,000. Now, if grandma gives that stock to her granddaughter, that $50,000 tax basis transfers along with it. So the granddaughter sells it down the line for, say, $600,000. She's looking at capital gains taxes on $550,000 of appreciation. That would mean a tax bill of anywhere between $82,500 and $110,000, depending on granddaughter's capital gains tax rate. All that money, poof, gone. All into the IRS's coffers. But if grandma held onto the stock and passed it through an inheritance, the granddaughter's new basis would be $500,000, not $50,000. If she sells it then for $600,000, she only pays tax on the $100,000 of appreciation after grandmother's passing, between about $15,000 and $20,000 instead, which is a huge difference in taxes, all because of one simple rule. And this, of course, applies to real estate too. A couple who bought a rental property for $300,000 years ago might see it appreciate to $1.5 million by the time they're gone. definitely a shack in California. But if they gift it now, their kids inherit the $300,000 basis. But if they inherit it later, that basis steps up to $1.5 million, potentially saving them 6 figures in taxes. So before you start handing off assets just to reduce your estate size, you need to consider whether the stepped up basis will work in yours, or more precisely your children's, favor. So, should you gift or hold? Here's the deal. Gifting isn't always bad. In fact, if you have assets that aren't appreciating significantly, gifting can be a great way to reduce your taxable estate and make sure your heirs don't end up paying an estate tax. It's also smart for cash transfers, which don't have a step up in basis issue. Cash is just cash. But if you're dealing with real estate, stocks, or any assets that's still growing in value, you need to weigh the long-term tax impact before making any moves with that. Because the last thing you want to do is rush into gifting only for your kids to end up with a giant capital gains tax bill down the road. Additionally, you know the government isn't going to allow you to just give all your money away and avoid taxes when you die, right? There's also something called a gift tax, a tax paid by the person giving a gift after they give too much to any one person. Currently, that maximum gift tax allowance before a 40% tax kicks in is $19,000 per person. That's how much you can give to any one person in a year before the gift tax kicks in. Going further, if you need to give more, then you can tap into that estate tax exemption amount early, currently $13.99 million, but subject to being cut in half, by telling the IRS you want to do so by filing a 709 gift tax return with your taxes in the year that you made the large gift. You would be tapping into that estate tax exemption amount early though, so not really reducing your taxable estate from a gift tax perspective, and we just discussed there's no step up in basis for those gifted assets, so this should not really be a strategy that's relied upon heavily, or at least not without planning things with your attorney, your accountant, and your financial advisor. If that was going to be necessary though, I would consider looking into more advanced planning techniques such as crummy trusts or the popular irrevocable life insurance trust. If you have extra cash, are planning on buying a life insurance policy anyway, and want to section off assets away from creditors, both yours and the beneficiaries, then that's something that you'll definitely want to look into, such as watching a certain YouTube attorney's video on the topic. I don't know, just saying. But circling back, there's a lot of uncertainty around tax laws right now, and I get why people are feeling the pressure to make moves before 2026. But estate planning isn't just about reacting to the latest tax changes, it's about long-term strategy. If you're thinking about gifting assets, talk to an estate planning attorney first. Look at your entire financial picture, consider the step up in basis, and make sure you're making decisions that actually save your family money, not just in estate taxes, but in capital gains taxes too. So let me ask you, had you thought about this before, or were you planning on gifting assets before realizing the potential tax hit? Let me know in the comments. And as always, if you found the video useful, be sure to like, subscribe, share the video with your kids or your tax person. I'm attorney Andrew Bethel, and I'll see you at our next meeting.